Hello and welcome to this session on fixed income instruments. In this session, you will learn about Public Provident Fund, National Savings Certificate, deposit products, fixed income mutual funds and fixed maturity plan. Fixed income securities can be classified according to the issuing party. This classification is a good way to understand the features and nuances of different types of fixed income securities. Fixed income securities can be issued either by the government or by the corporates. Government issued fixed income securities are subdivided into Public Provident Fund, National Savings Certificate, government bonds. Corporate issued fixed income securities are subdivided into deposits, mutual funds, fixed maturity plans and corporate bonds. We will cover all types of fixed income securities in this session except for government and corporate bonds, which will be covered in the next session. Let us begin with Public Provident Fund. What is Public Provident Fund scheme? PPF stands for Public Provident Fund. It is a scheme by the central government framed under the PPF Act of 1968. Tax saving is an important consideration of any earning individual, and as part of that, one of the famous tax saving tool is investment in PPF. Thus, we can say PPF is a government-backed long-term small savings scheme which was initially started by the government to provide retirement security to self-employed individuals and workers in unorganized sector. However, at present it is considered as the best tax saving scheme across all sections of population. Let us understand who can open a PPF account and who cannot. In other words, what is the eligibility criteria for PPF accounts? Only one PPF account can be maintained by an individual except an account that is opened on behalf of a minor. Non-resident Indians, NRIs, are not eligible to open an account. However, a resident who becomes an NRI during the tenure prescribed under Public Provident Fund can have an active PPF account. A PPF account can also be opened by either parent under the name of a minor. However, each person is eligible for only one account under his or her name. The mother and father both cannot open PPF accounts on behalf of the same minor. Thus, in case a couple has two children, they can maximum open 4 accounts, that is 2 in their own accounts and 2 in the name of their children under guardianship either of the parent. Whereas for the NRI account, schemes may continue to subscribe to the fund until its maturity on a non-repatriation basis. However, such an account will not be eligible for extension of 5 years at the time of maturity. Moving on to the benefits of PPF. The interest earned on the PPF account, that is on the full balance in your PPF account, is completely exempted from tax. In other words, your returns on investment in PPF are tax-free. Deposits up to Rs 1,50,000 per annum into your PPF account are deductible under Section 80C of Income Tax Act. Contributions to PPF accounts of the spouse or of the children are also eligible for tax deduction. Above all, the balance in the PPF account cannot be attached to any claim in case of debt or liability. Thus, the money is yours for life, and even after death, the same is available for your family. Next, we see the return on investments for PPF. So, the PPF return on investment has been around 8.5%, but on the higher side of that. You must understand that investment on PPF has a compounding effect, and the individual who has made the investment will earn interest based on the rate of the interest. For example, as per the new budget 2015, the new investment in PPF account will be Rs 1,50,000 and max investment in PPF for 15 years will be Rs 22,50,000. The total money earned from PPF account with interest will be 46,75,910 rupees. Now let's understand National Savings Certificate. The National Savings Certificate or NSC is a certificate issued by post offices in India. It is considered excellent small savings scheme. If an investment is planned, it can be used as a pension scheme post-retirement since the NSC offers monthly withdrawal plans. Their schemes are specially designed for government employees, businessmen and other salaried classes. We have seen what is NSC. Now let us dive into benefits of NSC. NSC has multiple benefits and most important of all is that the tax saving instrument and an amount up to 1.5 lakh can be claimed under Section 80C. NSCs are available for 5 and 10 years period. They're also available for minimum of rupees 500 and in multiples of rupees 500, 1000 and rupees 5000 and rupees 10,000. There are no maximum investment limit for an NSC. The types of NSC are as follows. First is single holder type of NSC, which is issued to the holder himself on the behalf of the minor. Second type is a joint A-type certificate that is issued jointly to two adults payable to both holders jointly. And lastly, joint B-type certificate which is issued jointly to two adults payable to either of the holders. After studying the types of NSC, let us now understand the return on investment for NSC. The interest rates are 8.5 per annum for 5 years and 8.8 per annum for 10 years. The interest has compounding effect which has been calculated half yearly. An investment of rupees 100 made in 10-year NSC will become rupees 232 after the tenure. So basically, it will give you approximately 134% return after 10 years, which can be used as an excellent tool to plan for post-retirement. Moving on to deposit products. To simplify it, banks accept deposits from people with surplus funds and lend it to people in need of funds. The deposit products are governed by the Banking Regulation Act 1949. Banks fulfill a social function. They encourage and facilitate savings by the general public and ensure their financial well-being. About 80% of bank resources are contributed by deposits. The RBI is empowered to regulate the workings of the product and banks are free to work within broad guidelines provided by the RBI. So why should a depositor come to a bank? Banks are preferred over other financial institutions because they fulfill expectations of depositor across various criteria. Firstly, we have safety. Banks are considered to be the safest and most trustworthy institution. This belief attracts deposits at relatively cheaper rates. Secondly, depositors are looking for liquidity. Banks have large resources and are able to allow withdrawals even on fixed deposits. Next, we see returns. Return is a function of safety and liquidity. Higher the level of safety and liquidity, lower is return and vice versa. Last but not the least is credibility. Banks are regulated by Reserve Bank of India, which lends credibility. Deposits can be classified under two broad categories, term deposits and demand deposits. The term deposits are a type of deposit with a fixed term. They are short-term deposits with maturities ranging anywhere from a month to a few years. Demand deposits are funds in an account from which the deposited funds can be withdrawn at any time without any advance notice to the depository institution. Demand deposits can be demanded by account holder at any given time. Now we move on to the term deposits in detail. Term deposits are deposits that are received for a fixed term or period. Deposits are accepted for a period ranging from a minimum of 7 days to a maximum of 120 months. Term deposits are withdrawable only after the expiry of the fixed period. The interest varies as per the period for which the deposit is contracted. Term deposits attract penalty if the deposits is withdrawn prematurely. There are three types of term deposits: fixed deposits, cumulative deposits, and recurring deposits. Let's take a look at types of term deposits in detail. First is fixed deposit funds. Fixed deposit funds are repayable on the expiry of time period agreed upon, and interest is paid at periodic intervals. Next is cumulative term deposits. Cumulative term deposits are fixed deposits with compounding of interest at quarterly intervals. Lastly, we come to recurring deposit funds. These funds are deposited at regular intervals and earn the interest of fixed deposits. Premature withdrawal of term deposits is possible, however, bank can charge a penalty. Moving on to the features of term deposits. Beside a higher interest rate, you can get temporary loan against these fixed deposits up to a maximum of 90% of the value of deposits. The rate of interest charge is 1 to 2% more than the normal loan interest. A margin of 10% is kept to recover additional interest in the case the interest is not paid till the maturity of the deposit. On maturity, the deposit is adjusted against the interest and the balance, if any, is paid. Let's take a look at an example. A customer deposits rupees 10 lakh for a period of 5 years at the rate of 10% per annum. But he decides to withdraw the amount prematurely after 1 year of depositing it. If interest rate on the date of deposit for 1 year was 8%, the interest is calculated on the deposit at 8% and not on 10%. Banks can also levy a penalty for premature withdrawal. Let us focus on regulations of term deposit products. Banks should issue term deposit receipts. Disposal instructions of deposits should be obtained in the application form. Term deposits should be freely transferable from one office of the bank to another. Term deposits gives the facility to withdraw the term deposit before the maturity date. The bank will notify the customer of impending due date of maturity. Finally, the penalty rate should be made known to the customers. Moving forward, let us study fixed income mutual funds. A mutual fund is a vehicle to mobilize monies from investors to invest in different markets and securities. In line with the investment objective agreed upon between the mutual fund and investors, in other words, through investment in a mutual fund, a small investor can avail of a professional fund management services offered by an asset management company. Mutual funds play a critical role. Their primary role is to assist investors in earning an income or building their wealth by participating in the opportunities available in various securities and markets. The mutual fund structure, through its various schemes, makes it possible to tap a large corpus of money from diverse investors. The money that is raised from investors ultimately benefits governments, companies, or other entities directly or indirectly to raise monies to invest in various projects or pay for various expenses. The mutual funds can keep a check on operation of investee company and their corporate governance and ethical standards. Higher employment, income, and output in the economy boost the revenue collection of the government through taxes and other means. This promotes further economic development and nation building. They can also act as a market stabilizer in countering large inflows or outflows from foreign investors. Mutual funds are therefore viewed as a key participants in capital market of any economy. Moving on to the types of mutual funds. First type is open-ended funds. Although some unit holders may exit from the scheme wholly or partly, the scheme continues operations with remaining investors. The scheme does not have any kind of time frame in which it is to be closed. The ongoing entry and exit of investors implies that the unit capital in an open-ended fund would keep changing on regular basis. Next are interval funds. The benefits for investors is that unlike in a pure closed-ended scheme, they are not completely dependent on the stock exchange to be able to buy or sell units of interval fund. Minimum duration of an interval period in an interval scheme is 15 days. Till then, units have to be compulsorily listed on stock exchanges to allow investors an exit route. Lastly, we have closed-ended funds. After NF4, investors will have to transact only through exchange. Since post NF4, the sale and purchase of units happen to or from the counterparty in a stock exchange and not to from the mutual fund. The unit capital of this scheme remains stable or fixed. Moving ahead, let us understand how mutual fund schemes actually operate. Let us start with mutual fund scheme announcements. Mutual fund schemes announce their investment objective and seek investments from public. The investment that an investor makes in a scheme is translated into certain number of units in the scheme. Thus, an investor in a scheme is issued units of a scheme. Next comes the new fund offer. When a scheme is first made available for investment, it is called a new fund offer. During the NFO, investors may have the chance to buy the units at their face value. Post NFO, when they buy into a scheme, they need to pay a price that is linked to its NAV. Finally, you have assets under management. The relative size of mutual fund company is assessed by their assets under management or AUM. When a scheme is first launched, assets under management would be the amount mobilized from investors. Further, if the scheme is open to receiving money from investors even post NFO, then such contributions from investor boost AUM. Conversely, if a scheme pays any money to investor either as a dividend or as consideration for buying back the unit of investors, the AUM falls. The AUM thus captures the impact of the profitability metric and flow of unit holder money to or from the scheme. Mutual funds have many advantages for investors. First advantage is professional management. Mutual funds offer investors the opportunity to earn income or build their wealth through professional management of their investable funds. There are several aspects to such professional management, viz. Investing in the line with investment objective, investing based on adequate research, and ensuring that prudent investment processes are followed. Next is affordable portfolio diversification. The affordable portfolio diversification ensures that all the eggs are not in the same basket. Consequently, the investor is less likely to lose money on all the investments at the same time. The next advantage is liquidity. Investors in a mutual fund scheme can recover the value of monies invested from the mutual fund itself. Depending on the structure of mutual fund scheme, this would be possible either at any time or during specific intervals or only during the closure of the scheme. Schemes where the money can be recovered from the mutual fund only on the closure of scheme are listed in a stock exchange. In such schemes, the investors can sell the units in stock exchange to recover the prevailing value of the investment. Lastly, investors also get tax benefits. Specific schemes of mutual fund give investors the benefit of deduction of amount invested up to Rs 10,000 in a financial year from their income that is liable to tax. This reduces their taxable income and therefore the tax liability. If an investor invests rupees 30,000 in RGESS schemes in a financial year, then he can reduce his taxable income for that previous year by 50% of rupees 30,000, that is rupees 50,000. In the following year, he still has an investment limit of rupees 20,000 available. The maximum NISM series 5A Mutual Fund Distributor Certification Examination 16 deduction that can be made from taxable income over the period of 3 financial years is 50% of rupees 50,000, that is rupees 25,000. Dividends received from mutual fund schemes are tax-free in the hands of investor. However, dividends from certain category of schemes are subject to dividend distribution tax, which is paid by the scheme before the dividend is distributed to the investor. Every coin has two sides. Let us look at the risk involved in mutual fund schemes. First is portfolio risk. It means that investors invest in a mutual fund scheme, which in turn invest in market, that is debt, equity, gold, or real estate in varying mixes, depending on the nature of scheme. There is no certainty regarding the performance of markets where a fund invests. Accordingly, the value of the portfolio and the NAV of the scheme fluctuate. Various investments have different level of risk. Astute fund managers understand the inherent risk. Thus, they can design portfolios that seek to moderate the risk as per the investment philosophy of each scheme. Next is portfolio liquidity. When investments are liquid, there is a transparent market benchmark to its value. Further, these investments can be sold to book profits or to generate liquidity for the scheme. SEBI has therefore laid down criteria to identify illiquid investments and also set a ceiling to proportion of such illiquid investments in net assets of a scheme. Prescribed ceiling is lower for open-ended schemes which have a greater need for liquidity because investors can offer their units for repurchase at any time. Now let's see liquid assets in scheme. Schemes maintain a certain proportion of their assets in liquid form. This could be either for two reasons. First, they believe that the market is overheated and therefore prefer to sell their investments and hold the proceeds in liquid form until the next buying opportunity comes up. Second, they want to provide contingencies such as impending dividend payment or repurchase expectations. Lastly, let's see liabilities in the scheme. The outside liabilities need to be paid by a scheme irrespective of the performance of the asset. It is bad enough when assets perform poorly, but if heavy outside liabilities need to be paid during that time, the scheme faces extreme pressure. Therefore, outside liabilities add to the risk in a mutual fund scheme. The practice of taking liabilities beyond what is inherent to normal business of a mutual fund scheme is called leveraging. Internationally, such leverage funds are commonly found. So, how do mutual funds compare with term deposits? In event that a bank fails, the deposit insurance scheme of government comes to rescue of small depositors. Up to rupees 1 lakh per depositor in a bank across branches will be paid by the insurer. Mutual fund schemes do not offer such insurance. The depositor can also prematurely close the deposit at any time with penalty in order to meet liquidity requirements. In a mutual fund scheme, no return is guaranteed. However, it is possible to earn returns that are much higher than in a bank deposit. With a bank deposit, the depositor can never earn return higher than the interest rate promised. Moving ahead, you will now learn about fixed maturity plans. While companies and banks can tell investors what they will pay, mutual funds cannot declare yield on close-ended debt schemes. They were earlier barred from disclosing the indicative portfolio of these schemes. However, last year, the Securities and Exchange Board of India, SEBI, allowed closed-ended debt schemes to disclose instruments in which they proposed to invest as well as floors and ceilings within 5% range of the intended allocation. The aim was to help investors arrive at the return they could expect. FMPs are closed-ended fixed maturity schemes that invest in debt securities such as treasury bills, T-bills, commercial papers, CPs, certificates of deposit, CDs, and government and corporate bonds. An FMP offer document should mention the instrument which the scheme plans to invest in, the proportion each instrument will account for, along with their credit quality and yields. Take a 3-month FMP which was opened for sale on 19 or 20 March 2012. The offer document gave the following disclosures. The scheme tenure is 91 days. Closed-ended debt funds cannot invest in securities with maturity period more than scheme's tenure. Finally, let us compare the various fixed income instruments or certain key parameters like return on investment and taxability. As you can see on the screen, mutual funds offer highest ROI at 16%, while bonds offer the lowest at around 8%. Though these instruments act as good investing schemes, it is completely dependent on the choice that a trader or investor based on his risk and return preference. With this, we reach the end of this session. Thank you and goodbye.